Welcome to Stock Informer for you. The noise in the market is loud, but we prefer to let the data do the talking. Hindustan Aeronautics Limited. It was the absolute darling of the defense bull run, skyrocketing to an all-time high of 5,065 rupees. But lately, the stock has cooled down, consolidating around the 4,368 rupees mark. Global mega brokerage, UBS, shocked the market by cutting its target to 3,200 rupees, while domestic giants like Jefferies are shouting buy with targets up to 5,300 rupees. So, who is right? Is the defense growth story crashing, or is this the ultimate dip buying opportunity for a debt-free monopoly? In this video, we are diving deep into HAL's newly released FY26 financial results, the massive order book, a major leadership shift, and the exact guidance provided by management to see if the stock belongs in your portfolio. Let's get started. The massive order book and monopoly moat. First, let's look at the elephant in the room, HAL's order book. HAL officially closed the fiscal year with an unbelievable backlog of 2.54 lakh crore rupees. To put that into perspective, HAL's total revenue for FY26 was 33,089 crore rupees. That means their order book is 7.7 times their annual revenue. Name me 3 other manufacturing companies that have their sales legally locked in for the next 7 to 8 years. You can't. This multi-lakh crore cushion is driven by mega deals like the 97 LCA Tejas Mark 1A fighter jets, valued at over 62,000 crore rupees, and massive repair and overhaul contracts. Best of all, their customer is the Indian Armed Forces. The customer default risk here is practically zero. Financials and the mixed Q4 reality. Now let's talk numbers. HAL's full year FY26 performance was structurally solid. Revenue from operations grew nearly 7% to 33,089 crore rupees. And net profit jumped 9% to cross 9,116 crore rupees. Plus, it is completely debt-free. But why did the stock correct? Look closely at the final quarter. While Q4 profits rose to 4,196 crore rupees, it was heavily propped up by other income like cash interest. Core operating EBITDA margins actually dipped from 38.6% down to 36.3%. Why? Because of rising employee wage and pension costs, and a temporary shift from high-margin servicing to lower-margin initial manufacturing phases. This minor margin squeeze is exactly why global brokerages turned cautious. The secret weapon, management and strategy change. But here is what the bears are missing. HAL's management strategy has fundamentally changed. On May 1st, 2026, Sri Ravi took over as the new chairman and managing director. He isn't just a bureaucrat. He is an aerospace veteran who previously ran HAL's operations and the Tejas division. His strategy? Aggressive outsourcing. HAL is no longer trying to build every single nut and bolt in-house. They are offloading lower complexity manufacturing to private Indian players and MSMEs like Tata Advanced Systems and L&T. HAL is transforming into the ultimate lead integrator. This frees up their internal factory capacity to do what they do best: high-end final assembly, testing, and avionics, which drastically accelerates how fast they can liquidate that 2.5 lakh crore backlog. Management guidance and the road to 2030. So, what is the outlook? In their latest investor call, management silenced critics by laying down a transparent roadmap. Top-line growth, they have guided for an accelerated 10% to 12% revenue growth for the current fiscal year. Margin defense. They expect EBITDA margins to comfortably stabilize at 30% to 31%, fully protected by raw material price escalation clauses. The engine update? HAL confirmed they have received the initial batch of engines from General Electric, and mass Tejas deliveries are on track to begin by August or September 2026, aiming for 15 to 20 jets this year. Future capex, they announced a massive 12,000 crore rupees capital expenditure plan leading up to 2030 to build domestic engine infrastructure and next-gen stealth drone technology. The valuation verdict? Let's talk valuation. At 4,368 rupees, HAL trades at a trailing PE of around 32 times. Historically, for a PSU, That sounds expensive. But compared to its peers like Bharat Electronics at 51 times or Bharat Dynamics at over 100 times, HAL is arguably the most reasonably priced large cap stock in the entire Indian defense sector. Factor in their forward earnings as Tejas production hits full speed, and that multiple drops to a very comfortable 25 times forward earnings by FY28. HAL is no longer a sleepy public sector unit. It's a structural monopoly entering a massive execution cycle. But I want to know from you, are you buying this dip in HAL, or do you think defense valuations are still too hot? Let me know in the comments below. Don't forget to hit that like button and subscribe for more deep dive financial breakdowns. See you in the next one.